Welcome to Sleeponomics, the channel where you fall asleep smarter. Here, we gently explore the hidden histories of global finance, technology, and innovation. Tonight's journey takes us deep into the heart of a tiny nation with an outsized footprint, Qatar. Over the next hour, you'll discover how a sovereign wealth fund quietly acquired stakes in some of the most powerful institutions on Earth. From Volkswagen and Barclays to the Eiffel Tower's surroundings and the World Cup itself. In the early morning silence of the Qatari desert, the skyline of Doha begins to shimmer under a rising sun. For centuries, this peninsula on the edge of the Persian Gulf was little more than a fishing outpost, known primarily for its pearling traditions and tribal settlements. But by the early 2000s, a once overlooked nation had become a financial powerhouse. The discovery of natural gas beneath the seabed in the latter half of the 20th century turned Qatar into one of the richest countries per capita in the world. And yet, the true transformation of Qatar's global identity would not come from the gas itself, but from what it chose to do with that wealth. In 2005, Qatar established the Qatar Investment Authority, or QIA, a sovereign wealth fund tasked with preserving and growing the nation's fortune for future generations. With billions in liquid assets and almost no domestic population pressure, QIA had a clear mandate. Think globally, invest quietly, and acquire influence not through politics, but through ownership. In its first decade, QIA made headlines for purchasing iconic assets, the Harrods department store in London, major shares in Barclays Bank, the Shard skyscraper, and even residential blocks around Parisian landmarks. What few people realized at the time was that this was just the beginning of a long-term strategy, one not driven by quarterly profits, but by patient power accumulation. It's fascinating to reflect on how different this approach was from the flashy acquisitions seen in Wall Street culture. QIA moved like water, silent, adaptive, and persistent. Where most funds operated on return cycles, Qatar thought in generations. Where private investors sought visibility, QIA sought discretion. And behind it all stood a small team of highly educated strategists operating from a few glass towers in Doha. As we begin this story, one question quietly guides us. How did a country smaller than Connecticut end up owning slices of the global economy? In the next chapter, we will explore how the QIA was born, shaped by geopolitical calculations, and a uniquely stable supply of wealth. It was not merely a financial vehicle, but a strategic compass guiding Qatar through an uncertain century. In the spring of 2005, as the world recovered from the aftermath of the dot-com bubble and adjusted to the rising tide of oil prices, Qatar's leadership took a quiet but decisive step. With the formal creation of the Qatar Investment Authority, the country signaled a shift from resource extraction to long-term global investment. It was a move born not of desperation, but of vision, a recognition that even the richest natural gas reserves would not last forever. At the time, the idea of a sovereign wealth fund was not new. Countries like Norway and Singapore had already demonstrated how national capital could be preserved and multiplied through global investments. But Qatar's context was unique. With one of the smallest native populations among oil-rich nations and one of the highest income levels per capita, it faced little pressure to fund domestic welfare. Instead, it could think bigger, not only preserving wealth, but expanding influence. The QIA was designed from the beginning as a hybrid entity, part financial institution, part geopolitical instrument. It reported directly to the Emir of Qatar, but operated with a degree of autonomy rare in the region. Its leadership included graduates from top Western universities with backgrounds in finance, law, and international strategy. Their task was simple in principle but complex in execution: to quietly acquire high-value assets that would secure Qatar's future standing in a post-oil world. One of the fund's first strategic decisions was to base many of its operations in London, a symbolic and practical choice. The United Kingdom was a former colonial power in the Gulf, home to deep capital markets and a gateway to European finance. Through a London-based subsidiary, QIA began purchasing properties, equities, and institutional partnerships. Early targets included blue-chip companies, luxury real estate, and financial services, sectors that offered both prestige and stability. Unlike speculative investors, QIA did not seek short-term returns or media attention. Its investments were deliberate, often structured as minority stakes with board influence but limited visibility. This allowed it to avoid the political scrutiny that often accompanies foreign acquisitions. In effect, QIA acted like a shadow shareholder, influencing major sectors of the global economy without ever needing to make noise. By 2007, just 2 years after its founding, QIA had quietly accumulated tens of billions in assets. It was not yet a household name, but insiders in the financial world had taken notice. In boardrooms from Zurich to Tokyo, a new kind of investor had arrived, one that did not fit the familiar mold of hedge funds or multinational banks. It was national but global, conservative but strategic, quiet but deeply ambitious. There is something quietly compelling about this kind of power. It does not shout. It does not dominate headlines. It simply accumulates influence, access, leverage, and waits for the right moment to act. In the next chapter, we will follow QIA's first major moves into public view, a string of bold, high-profile purchases in the heart of London that would set the tone for a decade of strategic acquisitions. From historic department stores to modern skyscrapers, Qatar began to buy symbols, and with them, stories. As the Qatar Investment Authority moved into its third year of operation, its leaders began to shift from quiet preparation to visible action. While early acquisitions had been modest and largely unnoticed, 2007 marked a turning point. That year, QIA began targeting some of London's most iconic assets, not merely for financial returns, but for symbolic value. These were investments that would tell a story, both to the global financial elite and to Qatar's own people, that the tiny desert state was becoming a serious player on the world stage. London was more than just a logical choice. It was a city steeped in financial history, cultural prestige, and diplomatic networks. For a new sovereign investor, acquiring assets in London was akin to being accepted into an exclusive global club, and QIA was not interested in being a guest. It wanted a seat at the table. One of the first moves that drew international attention was the acquisition of a significant stake in Sainsbury's, the venerable British supermarket chain. Through a series of strategic share purchases, QIA became the company's largest shareholder. The move was not welcomed by all. British media, political figures, and even members of the public voiced concern about foreign ownership of a household brand. But QIA remained calm, reassuring stakeholders that it had no intention of dismantling or radically altering the company. This steady-handed approach was deliberate. Qatar was playing the long game. It understood that trust, not just capital, was the currency of influence. And so, rather than engaging in corporate battles or management overhauls, QIA cultivated a reputation as a respectful, patient investor. It was this attitude that would pave the way for an even more symbolic acquisition. In 2010, the QIA finalized the purchase of Harrods, the world-famous department store in Knightsbridge. The price was estimated at around £1.5 billion. For many in Britain, this was a moment of pause. Harrods was more than a retailer, it was a cultural institution. Its green awnings, gold-lettered signage, and opulent interiors had hosted royalty, diplomats, and generations of Londoners. QIA's acquisition of Harrods made headlines not only for its scale, but for its emotional weight. It marked a shift in how sovereign wealth was perceived. No longer confined to oil rigs or stock portfolios, Qatar was now visibly entwined with the everyday life of the West. A Middle Eastern fund now owned a place that once symbolized British imperial luxury. It's fascinating to consider how subtle, yet profound, this shift was. There was no aggressive marketing, no rebranding, no major restructuring. Harrods continued to operate as it always had, but now under Qatari ownership. This was soft power, not through diplomacy or military presence, but through economic integration. Beyond retail, QIA was also making architectural statements. It became the lead investor in the Shard, the tallest building in Western Europe. Rising from the London Bridge quarter, the Shard symbolized modern ambition and international partnership. Designed by Renzo Piano, the glass structure reflected both the sky above and the city below, a fitting metaphor for Qatar's evolving identity. Deeply rooted in its own culture, yet reaching outward into the global financial and cultural system. In the next part of this chapter, we will explore how these London investments were not isolated gestures, but part of a wider pattern of influence building, one that would extend far beyond retail and real estate, into the very financial institutions that shaped the global economy. While retail icons like Harrods and architectural landmarks like the Shard attracted media attention, much of the Qatar Investment Authority's most consequential work was unfolding behind closed doors. Away from the public eye, QIA was methodically building a portfolio of financial holdings that reached deep into the machinery of the global economy. These were not investments made for headlines. They were made for influence, access, and long-term leverage. At the heart of this strategy lay the financial sector: banks, insurance firms, exchanges, institutions that move capital, not just store it. In the years following its founding, QIA quietly acquired stakes in some of the most prominent financial institutions in Europe. Among the most notable was Barclays Bank, one of the oldest and most globally active British banks. During the global financial crisis of 2008, most investors were retreating, markets were falling, confidence was collapsing, but QIA saw an opportunity. Barclays needed capital, and Qatar had liquidity. In a series of complex deals, QIA, along with Abu Dhabi's sovereign fund, injected billions into Barclays, helping it avoid a government bailout. In return, Qatar received preferential shares and convertible notes, setting up a future windfall when the market stabilized. This was more than just a rescue. It was a strategic insertion into the beating heart of British and global finance. By becoming one of Barclays' largest shareholders, QIA gained insight, board-level influence, and a long-term foothold in global banking, and it achieved this with almost no political resistance. While other bailout mechanisms triggered public backlash, Qatar's investment was framed as stabilizing, not threatening. This pattern repeated itself elsewhere. In Credit Suisse, QIA became a significant shareholder, recognizing the value of positioning within Switzerland's elite banking network. It acquired stakes in the London Stock Exchange, infrastructure funds, and energy trading platforms. In each case, the guiding principle was the same: invest quietly, stay for the long term, and avoid attention. It is fascinating to reflect on how consistent and deliberate this strategy was. QIA did not seek to control these institutions outright. It preferred strategic minority stakes, enough to earn access, but not enough to trigger scrutiny. This allowed it to build a kind of invisible architecture of influence across the financial system. Like a spider quietly weaving a web, Qatar's investments connected across sectors, countries, and markets. Even more subtly, these investments bought something priceless: information flow. As a trusted investor, QIA had access to private briefings, industry insights, and confidential outlooks that few outside the executive world could see. And with such knowledge came foresight, a powerful advantage in shaping future decisions. By 2012, Qatar was no longer just a newcomer. It was a quiet heavyweight in the rooms where global capital moved. And yet, its style remained unchanged: discreet, methodical, patient. The world began to realize that something rare was unfolding: a nation with immense liquidity, no electoral pressure, and a sovereign strategy guided by foresight rather than quarterly returns. In the next chapter, we'll leave Europe behind and follow QIA's expansion into new markets, from the skyscrapers of Manhattan to the cultural avenues of Paris. It was there that Qatar's investment strategy took on a new layer, not just financial, but cultural and symbolic. As the Qatar Investment Authority steadily advanced its global ambitions, it soon looked beyond the British Isles to two of the world's most symbolically loaded urban centers, New York and Paris. These were not random selections. They were deliberate targets, pillars of Western finance, culture, and soft power. By embedding itself in these cities, QIA was no longer just collecting valuable assets. It was intertwining itself with the emotional, aesthetic, and institutional heart of the global order. Where London offered historical links and legal familiarity, New York represented pure financial centrality. It was the capital of capital, a place where markets are not just traded, but defined. QIA's entry into Manhattan was as discreet as ever. The fund didn't acquire towering logos or flash investments. Instead, it began placing money into prime real estate, private equity partnerships, and infrastructure vehicles with long-time horizons and quiet governance rights. One of QIA's earliest moves in New York was the acquisition of luxury residential properties in Midtown and the Upper West Side. These weren't flamboyant purchases. They were enduring ones, made through limited liability companies, sometimes with intermediaries, always with confidentiality. QIA's goal was not to make headlines, but to anchor its presence in the physical heart of global finance. Over time, QIA expanded into commercial real estate, taking stakes in office buildings and development projects close to Wall Street and the financial district. It also placed money in data centers, logistics hubs, and toll infrastructure across the eastern seaboard, much of it routed through American partners. This allowed QIA to benefit from domestic expertise and avoid the scrutiny that often accompanies foreign direct investment in sensitive assets. In parallel, QIA forged ties with major U.S. asset managers and private equity firms, becoming a limited partner in funds that gave it exposure to technology, healthcare, infrastructure, and energy. These relationships weren't just financial, they were informational. By aligning itself with the dealmakers of Manhattan, Qatar gained insight into market trends, regulatory shifts, and innovation pipelines, years before those ideas entered public view. It's fascinating to pause here and consider the depth of this strategy. QIA did not simply buy American assets. It embedded itself in American decision-making. It became a silent stakeholder in the growth narrative of the U.S. economy without ever needing to appear on a billboard or attend a press conference. At the same time, across the Atlantic, another theater of influence was unfolding, one based not in balance sheets, but in symbols. In Paris, QIA took a different but equally calculated approach. It sought cultural capital, not just real estate or equity holdings, but the power of aesthetics, heritage, and luxury. Through a series of quiet deals, QIA acquired properties in some of Paris's most exclusive districts, around the Place Vendôme, Avenue Montaigne, and Rue Saint-Honoré. These were not merely profitable holdings. They were visual statements. Qatar was not just an investor. It was now a participant in the European identity industry. The fund also took minority stakes in French luxury houses, some directly, others through holding groups or sovereign partnerships. These included exposure to firms in fashion, fragrance, jewelry, and haute couture. Each investment reinforced the message. Qatar was aligning itself with timeless elegance, historical legacy, and global prestige. And then there was the softest layer of power, patronage. QIA supported cultural restoration projects, museum initiatives, and art foundations in France. It wasn't just about economic returns, it was about credibility. These gestures, modest in appearance, were incredibly effective in securing trust. In a continent often wary of foreign capital, Qatar positioned itself not as a buyer, but as a custodian of heritage. The contrast between the two strategies, New York's financial depth and Paris's cultural symbolism, reveals a sophisticated understanding of influence. In Manhattan, Qatar pursued access to systems. In Paris, it pursued association with symbols. One built reach, the other built reputation. And both, in their own way, built resilience. What's especially notable is that in both cities, Qatar avoided the mistakes made by other sovereign investors. There were no hostile takeovers, no publicity campaigns, no overt branding. QIA maintained a posture of quiet stewardship. It let its assets speak for themselves. By the mid-2010s, QIA had become an unspoken presence in dozens of boardrooms and executive corridors throughout New York and Paris. It had partnered with the builders of towers and the designers of luxury goods. It had inserted itself into the conversations that shape global taste and global trade, all without ever needing to dominate a single front page. It's worth reflecting on what this means. In a world driven by visibility, Qatar chose invisibility. Where others chased headlines, it pursued continuity. And in doing so, it secured something more enduring than publicity. It secured permanence. In the next chapter, we'll explore how Qatar moved from cultural and financial investment into one of the most unexpected arenas of industrial strategy, the European automotive sector. There, through a dramatic investment in Volkswagen, QIA would gain not just dividends, but geopolitical leverage. By the late 2000s, the Qatar Investment Authority had already established a quiet but significant footprint in global real estate, finance, and culture. Its presence in London, Paris, and New York had been strategic, deliberate, and largely discreet. But in 2009, QIA made a bold and unexpected move, one that would shift the narrative from urban assets and luxury to the heart of European industrial power. This was not a symbolic gesture. It was a calculated investment in one of the continent's most iconic and politically sensitive companies, Volkswagen. To understand the magnitude of this decision, it helps to understand what Volkswagen represented at the time. Founded in the 1930s and rebuilt after World War II, VW was more than just a car maker. It was a symbol of German resilience, efficiency, and industrial prowess. With brands like Audi, Porsche, Seat, and Skoda under its umbrella, and a growing footprint in China and the United States, Volkswagen was one of the world's largest automakers by volume. Its influence extended beyond engineering. It was tied to the fabric of post-war European economic development. Qatar's entry into this arena began quietly. In 2009, it announced that it had purchased 17% of Volkswagen's ordinary shares, and nearly almost the same in voting rights, effectively becoming the company's third-largest shareholder, behind the Porsche and Lower Saxony factions. The deal was complex but strategic. It took place in the middle of a power struggle between Porsche and Volkswagen, as the two companies were locked in a dramatic merger battle that had been unfolding over years. Porsche, then a smaller but highly profitable automaker, had been trying to take over the much larger Volkswagen through financial engineering and share accumulation. The plan had backfired. Porsche's holding company had accumulated massive debt, and the deal was teetering on collapse. Volkswagen, meanwhile, saw an opportunity to turn the tables and absorb Porsche instead. In stepped the QIA with liquidity, neutrality, and a long-term horizon. By buying into Volkswagen at this critical juncture, Qatar provided the cash injection that stabilized the situation. More importantly, it became a balancing force between the competing interests. With no historic ties to either side, the QIA acted as a diplomatic shareholder, neither hostile nor passive, but strategic. Its involvement was welcomed by the German government and by management on both sides of the merger. It's fascinating to reflect on how this was more than a financial play. It was industrial diplomacy. Qatar was inserting itself into one of Europe's most sensitive economic sectors, and doing so not as a disruptor, but as a stabilizer. The investment granted Qatar more than just shares. It gained a seat at the table. Through supervisory board participation and voting rights, QIA became a stakeholder in key corporate decisions, ranging from strategic direction and global expansion to research, investments, and labor relations. It was a position of quiet influence, exercised not through control, but through presence. For Qatar, the Volkswagen stake served multiple goals. First, it was a classic diversification strategy. Auto manufacturing provided exposure to a different set of economic drivers: consumer demand, mobility, materials, and emerging technologies like electric vehicles. Second, it allowed Qatar to position itself within the European industrial value chain, at a time when manufacturing was becoming more politically important in a post-crisis world. Third, and perhaps most importantly, it offered leverage in international relations. Germany and Qatar had long maintained diplomatic ties, but this deal deepened their economic interdependence. German executives, engineers, and political leaders now had a direct line of interest in Qatar's stability and prosperity. That mattered in negotiations over energy, in global forums, and in regional security matters. Over the following years, QIA maintained and slightly adjusted its Volkswagen stake, showing flexibility without abandoning the position. As Volkswagen expanded into electric vehicles, mobility platforms, and software-driven strategies, Qatar remained involved, quietly supporting the transformation. It never demanded aggressive returns or made public demands. It operated as it always had, patiently and discreetly. This approach paid off in subtle ways. Qatar gained access to cutting-edge industrial knowledge. It learned about EV platforms, supply chain resilience, and labor management dynamics inside one of the world's most complex manufacturing firms. This knowledge fed back into its own national strategies, informing logistics projects, infrastructure planning, and economic diversification under the Vision 2030 plan. It also boosted Qatar's credibility. In a world where sovereign wealth was often seen as opaque or extractive, QIA was building a different image, that of a reliable, long-term industrial partner. In boardrooms across Europe, this reputation began to take root. Sovereign capital, when deployed patiently and respectfully, could be an asset rather than a threat. But it wasn't just about Europe. The Volkswagen play also gave Qatar indirect access to China, Latin America, and the US, where Volkswagen had large operations. Through its stake, Qatar could quietly observe global consumer trends, regulatory shifts, and geopolitical frictions in real time, filtered through the lens of an industrial giant. By the mid-2010s, Volkswagen had recovered from its corporate power struggles and was entering a new phase of global expansion. Qatar, for its part, had accomplished something subtle but powerful. It had inserted itself into the core of one of Europe's most prized industrial ecosystems, and done so without confrontation, without noise, and without short-termism. The Volkswagen stake was never just about cars. It was about presence, about learning, about positioning, and above all, it was about earning a seat at the table of global industrial policy, not through lobbying, but through ownership. In the next chapter, we will explore how Qatar's sovereign fund responded to the global financial crisis of 2008, not as a victim, but as an opportunist. While the world burned, Qatar bought. And what it bought would shape its global reach for decades to come. In the world of finance, few periods are as defining or as devastating as the global financial crisis of 2008. Across continents, institutions collapsed, credit froze, and confidence evaporated. Entire economies teetered on the brink of collapse. But while most investors sought to minimize damage and preserve liquidity, a small number of sovereign players saw something else. A rare window to reshape the global investment landscape. Among them, Qatar stood out, not for the size of its interventions, but for their timing, subtlety, and strategic depth. The Qatar Investment Authority was still relatively young in 2008. It had only been formally established for 3 years, but those years had been used wisely. The fund had developed a strong internal team, established key relationships in London and New York, and built up a vast reservoir of liquidity drawn from the country's immense natural gas wealth. When the crisis struck, QIA found itself in a uniquely powerful position. It had cash, it had access, and it had no domestic political pressure to pull back. Where others were selling, Qatar started buying. One of the earliest and most significant examples came in late 2008, when Barclays Bank, one of the pillars of British finance, faced a serious capital shortfall. Unlike other banks that turned to the UK government for a bailout, Barclays wanted to avoid state control. It needed alternative funding, fast. In stepped Qatar. Through direct and indirect channels, including the QIA and the personal investment vehicle of the Qatari royal family, Qatar injected over £7 billion into Barclays. The deal was complex and controversial. Qatar received preferential terms, convertible notes, high interest payments, and long-term warrants. These terms would later be scrutinized by regulators and even led to legal proceedings, although no wrongdoing was proven against the fund itself. From an investment standpoint, the move was masterful. Qatar not only saved a key financial institution, it also positioned itself as a major stakeholder with board-level influence. It showed the world that it was not just a passive investor, but an active participant in shaping the financial future of the West. That same year, Qatar also deepened its relationships with several global banks, including Credit Suisse, Deutsche Bank, and other European financial institutions under stress. In each case, it moved carefully, never acquiring full control, but enough to earn respect, dividends, and visibility. But Qatar's crisis strategy wasn't limited to banks. It extended to real estate, infrastructure, and commodities. In real estate, the downturn created a flood of distressed assets. Prime properties in London, Paris, and Manhattan suddenly became available at heavily discounted prices. QIA moved quietly but decisively. In London alone, it acquired trophy properties, commercial complexes, and residential portfolios that would have been out of reach just a year earlier. In infrastructure, Qatar increased its stakes in energy pipelines, logistics networks, and utility companies. These were stable, long-term assets that governments were eager to privatize in exchange for immediate cash. Qatar's sovereign fund often provided that liquidity on terms that favored its long horizon. It is fascinating to pause and reflect on what made Qatar so agile during this period. While many sovereign wealth funds were constrained by bureaucracy or political oversight, the QIA had flexibility. It could act quickly with relatively few internal veto points. It had a leadership team composed of professionals trained in global finance, not just domestic policy. And most of all, it had a philosophy. Moments of fear are moments of entry. That philosophy reached its peak during the post-2008 recovery period. As markets stabilized, QIA's crisis-era investments began to mature. Many of them yielded enormous returns. The Barclays stake alone generated billions in profit, especially as preferred shares were converted and sold into a recovering market. But beyond profit, what QIA gained was positioning. It had helped rescue critical Western institutions without imposing sovereignty or branding. It had avoided the pitfalls that many other foreign investors encountered: nationalist backlash, regulatory resistance, and cultural friction. By staying quiet, disciplined, and respectful, Qatar earned a reputation for reliability. It is worth noting that this reliability wasn't just financial. During the crisis, QIA's decisions helped preserve jobs, stabilize housing markets, and ensure the continuity of services in countries far beyond its own borders. It had become a crisis stabilizer, a role typically reserved for central banks or multilateral institutions. By 2011, QIA had doubled its global asset footprint. It now held influential positions in finance, real estate, infrastructure, and industry. The crisis, while devastating for many, had served as Qatar's great accelerant. It had taken a fund barely 3 years old and turned it into a pillar of the post-crisis global order. From that moment on, QIA was no longer seen as an emerging fund. It was now regarded as a core actor, one whose decisions could shift markets, influence boardrooms, and shape the trajectory of industries. In the next chapter, we'll explore how Qatar extended its influence into entirely new arenas, not just through money, but through media, sport, and culture. The stage was no longer the boardroom or the factory. It was the stadium, the news network, and the global stage. And at the center of it all stood Qatar, watching quietly but moving with purpose. By the early 2010s, Qatar had quietly secured strategic positions in banking, real estate, infrastructure, and industry. Its sovereign wealth fund was now one of the most influential in the world, though few people outside elite circles knew the full extent of its reach. Yet, in parallel with this financial expansion, Qatar was launching another kind of campaign, one not measured in dividends or asset sheets, but in global perception. This was the era of soft power, a subtle force that shapes influence through attraction, not coercion. And no initiative demonstrated this more dramatically than Qatar's successful bid to host the FIFA World Cup in 2022. When Qatar was announced as the host nation in December 2010, the world was stunned. A country smaller than Connecticut, with scorching summer temperatures and limited football history, had secured the rights to stage the most watched sporting event on Earth. The decision sparked controversy, accusations of vote buying, and intense media scrutiny. But beneath the headlines was a strategy years in the making. Hosting the World Cup was not just about football, it was about visibility. Qatar saw the event as a nation branding vehicle, a chance to place itself at the center of global attention, not as an energy exporter, but as a cultural and diplomatic actor. But the World Cup was only the most visible symbol of a broader soft power strategy. At the same time, Qatar was investing in global media. Through Al Jazeera, it had already transformed the Arab media landscape, offering an alternative to Western news narratives. Now, it expanded further with Al Jazeera English, reaching audiences across Africa, Asia, and the West. The channel provided Qatar with an international voice, carefully editorial, often controversial, but undeniably influential. Through its framing of global events, Qatar began shaping discourse. This was soft power in its purest form, controlling the frame through which others saw the world. Meanwhile, in sports and entertainment, Qatar moved strategically. It purchased the French football club Paris Saint-Germain, PSG, in 2011, transforming it into one of Europe's most high-profile teams. Star players were recruited, sponsorships poured in, and the club became an extension of Qatar's image, a fusion of excellence, ambition, and global flair. Qatar also founded beIN Sports, a global sports broadcasting network that quickly acquired rights to major football leagues, tennis tournaments, and Olympic events. It was more than a business. It was a way to shape what audiences saw, heard, and believed. In parallel, the Qatar Museums Authority began acquiring works of art, sponsoring exhibitions, and building world-class institutions. From Jean Nouvel's desert-inspired National Museum of Qatar to the Museum of Islamic Art, the country positioned itself as a new hub of cultural preservation and creation. These efforts were not disconnected. They were part of a larger vision, to make Qatar known, respected, and trusted, not just in oil markets, but in the hearts and minds of global citizens. It's worth reflecting on how unusual this was. Most sovereign wealth strategies stop at financial diversification. Qatar's went further. It sought reputation, diversification. It understood that in a post-industrial world, narrative matters. Being seen as modern, open, and dynamic wasn't just about image. It was about influence protection. There were clear benefits. Cultural engagement made Qatar harder to isolate. Media ownership allowed it to influence how it was covered. Sports investments opened doors in diplomatic circles that traditional embassies never could. And the World Cup, with its billions of viewers, offered a platform no nation could buy on the open market. But these moves were not without controversy. Human rights groups criticized labor conditions in World Cup construction. Political critics questioned Al Jazeera's editorial independence. And rival Gulf states accused Qatar of using soft power as a smokescreen for geopolitical ambitions. Qatar responded not with withdrawal, but with refinement. It improved stadium conditions, engaged with human rights monitors, and hosted diplomatic forums. Its soft power campaign evolved, not perfect, but increasingly sophisticated. By the time the World Cup arrived in 2022, Qatar had already won much of the game. The infrastructure was complete. The global cameras had arrived. The world was watching, and even in critique, it was saying Qatar's name. In the next chapter, we will examine how this visibility came with a price. For as Qatar's presence grew, so did the backlash. From regional embargoes to calls for transparency, the quiet empire began to face loud opposition. And the test was no longer how to invest, but how to endure. Every rise invites reflection, but true power eventually invites resistance. For over a decade, Qatar had built a silent empire through ownership, diplomacy, culture, and sport. But as its influence widened, so too did the lens of global attention. And in the late 2000s and 10s, the story began to shift. What had once been quiet admiration now included louder questions. Qatar, once celebrated for its foresight and wealth, began to face scrutiny from neighbors, allies, and international observers. The tools of soft power that had helped it rise, media, sport, investment, were now examined through a different filter. The question was no longer what Qatar owned, but why it owned so much, and to what end. The first and most dramatic sign of backlash came in June 2017, when Qatar found itself the target of a sweeping diplomatic and economic blockade. Led by Saudi Arabia, the United Arab Emirates, Bahrain, and Egypt, the coalition severed ties with Doha, closed land and air borders, and accused Qatar of supporting extremism and interfering in regional affairs. Qatar denied the accusations and refused to meet the list of demands issued by the bloc. The blockade was more than a diplomatic rupture. It was a direct challenge to Qatar's model of influence. The soft power it had carefully constructed through Al Jazeera, global investments, and cultural positioning was now seen by its neighbors as a geopolitical provocation. In many ways, the blockade tested the resilience of Qatar's sovereign strategy. Could a small country, surrounded and politically isolated, maintain its global reach? The answer, perhaps surprisingly, was yes, and in some ways, even more than before. Qatar rapidly rerouted trade flows, secured alternative supply lines through Oman, Turkey, and Iran, and increased domestic production of key goods. The QIA adjusted its investment posture, but did not retreat. In fact, some of its global partners expressed renewed appreciation for the fund's stability amid regional turmoil. The crisis had a paradoxical effect. It isolated Qatar regionally, but it elevated its position globally. In Europe, Asia, and the United States, investors and diplomats began to see Qatar not just as a Gulf player, but as a strategic actor with its own independent identity. Still, the challenges did not end with the blockade. Transparency became another front of criticism. Sovereign wealth funds, by design, are not always open institutions. They operate across borders, through layers of legal structures and shell entities. But as QIA's holdings grew, especially in high-profile sectors like media, luxury, and tech, calls for transparency increased. Some European lawmakers raised concerns about the extent of foreign state ownership in sensitive sectors. Think tanks asked, what happens when a government fund owns the companies that influence our culture? The question of accountability was especially sharp around Al Jazeera and beIN Sports. Accusations of political bias, copyright disputes, and lobbying conflicts emerged. In the world of sport, Qatar's heavy investments in European football and its hosting of the World Cup drew attention to labor conditions, migrant rights, and sustainability claims. To its credit, Qatar responded, not always with openness, but with calculated adjustments. Labor laws were revised, even if implementation remained uneven. Al Jazeera shifted tone in some areas, emphasizing global perspectives. QIA began publishing annual reports with more detail, offering some transparency, though still below global best practice. Yet these changes did not fully silence the critiques, because they pointed to something deeper, a mismatch between Qatar's influence and its size, between its global presence and domestic constraints. How could a country of under 3 million people, including foreign workers, own so much, shape so much, and still remain so unfamiliar to the average global citizen? This mismatch generated suspicion. Was Qatar a force for open investment or for quiet manipulation? Was its media reach about dialogue or agenda? Was its ownership of luxury and infrastructure about partnership or power? These were not easy questions. They reflected the new world Qatar had entered, a world where influence must be explained, not just exercised. At home, the backlash forced internal recalibration. The Vision 2030 strategy, once focused primarily on diversification, now included reputation management. Institutions were tasked not just with acquiring assets, but with managing narratives. Diplomacy became more public-facing. Cultural outreach expanded, not just through events, but through education and philanthropy. It is fascinating to consider how quietly the tone of Qatar's rise had shifted. In earlier years, invisibility had been a strength. Now, it was becoming a vulnerability. The world was no longer content to see Qatar as a silent partner. It wanted to know what kind of partner it really was. And this was not just about Qatar. It reflected a broader reckoning with sovereign wealth, state capitalism, and the blurred lines between government and global markets. Qatar had simply been the most visible, the most ambitious, and therefore, the first to be confronted. In the next chapter, we'll explore how Qatar responded to these challenges, not by retreating, but by moving into the future. Artificial intelligence, green energy, digital infrastructure, these were the next frontiers, and Qatar intended to shape them not with oil, but with ideas. By the early 2020s, Qatar had already defied many expectations. It had weathered a regional blockade, earned global visibility through cultural and sporting platforms, and used its sovereign wealth to place long-term bets across industries. Yet, beneath the surface, its leadership was increasingly aware of a reality that no desert skyline or football stadium could distract from. The world was entering a new era, an era defined not by fossil fuels or physical infrastructure, but by data, algorithms, and digital sovereignty. For a nation whose fortune was built on natural gas, the question was existential. What happens after energy? The answer was not retreat, but transformation. Under its National Vision 2030, Qatar began reorienting its sovereign investment strategy toward the next generation of global industries: artificial intelligence, biotechnology, green energy, and digital infrastructure. These were not passive themes, they were deliberate targets. And the shift marked a new chapter in Qatar's silent campaign for relevance in a post-carbon world. Among the most visible fronts of this strategy was AI and quantum computing. While countries like the United States and China dominated the headlines, Qatar moved differently, behind the scenes through funding, partnerships, and equity. The Qatar Investment Authority began backing venture capital funds focused on AI startups, autonomous systems, and cybersecurity platforms. In the US, it placed capital into funds that backed early-stage innovation in language models, machine learning platforms, and data analytics firms. These investments were rarely branded, but they gave Qatar access to emerging technologies long before they reached public markets. In Europe, QIA co-invested in quantum research labs and supported university spin-outs in the fields of encryption, secure cloud storage, and artificial intelligence governance. The fund's approach followed a pattern: avoid direct control, focus on knowledge pipelines, and prioritize proximity to innovation ecosystems. In parallel, Qatar built its own local capacities. The Qatar Computing Research Institute, QCRI, became a hub for AI research in the region, attracting global talent and partnering with institutions like MIT, Oxford, and European AI consortia. It focused on applications in language processing, data security, and climate modeling, areas where AI could enhance national resilience, not just economic return. It's fascinating to reflect on how these efforts redefined the very concept of resource extraction. Qatar, once known for pulling gas from beneath the seabed, was now harvesting information, insight, and innovation. The raw material was no longer methane, but machine learning. The pipelines were no longer physical, but digital. The transformation extended beyond tech. Qatar also moved heavily into green energy and sustainability technologies. Through QIA and affiliated funds, it acquired stakes in solar projects, battery storage platforms, and electric mobility companies. It supported hydrogen research and invested in circular economy initiatives in Europe and Asia. In doing so, it hedged its own economic future. While the state continued to sell natural gas, it also funded the tools designed to replace it. Domestically, Qatar began developing smart infrastructure, from AI-powered traffic systems to predictive energy grids and water management platforms. The goal was not just to showcase innovation, but to test and localize it, building a scalable model of high-tech governance in the Gulf. Another quiet frontier was digital infrastructure and data centers. As global attention shifted toward data privacy, cloud governance, and digital independence, Qatar moved to secure its place in this conversation. It invested in data hubs, submarine cable projects, and digital storage companies, not to dominate the sector, but to ensure that it was not left out of it. These moves served multiple goals. First, they diversified the portfolio, reducing long-term exposure to hydrocarbon volatility. Second, they positioned Qatar within knowledge economies where ideas move faster than commodities. Third, and perhaps most critically, they elevated Qatar's strategic value. In a world increasingly defined by digital dependence, any country that provides capital, infrastructure, and expertise becomes a necessary partner. But with these new frontiers came new complexities. AI is not just a technology, it is a terrain of ethics, geopolitics, and power. As Qatar embedded itself in this space, it had to navigate questions of bias, surveillance, and algorithmic fairness. It had to manage relationships with both US and Chinese tech players, two powers increasingly wary of cross-border tech investment. Qatar's answer was to remain, as always, measured. It avoided extremes. It did not choose sides. It positioned itself as a bridge investor, a neutral funder of innovation, seeking long-term alignment over short-term headlines. And as AI moved into education, defense, and governance, Qatar also began investing in digital diplomacy, funding think tanks, supporting academic exchanges, and launching policy forums on the ethics of artificial intelligence. It wanted not only to fund the tools of the future, but to shape the rules that would govern them. The QIA was no longer just a buyer of buildings or banks. It had become a stakeholder in the architecture of tomorrow, and that architecture would not be made of steel or stone. It would be written in code. In the next chapter, we'll step back and reflect. With investments across continents and sectors, with cultural and technological influence, what exactly is Qatar building? Is it a portfolio or an empire? Is it a hedge fund or a quiet system of global power? And where ultimately does it lead? By now, the outlines of Qatar's global presence are no longer just impressive, they are profound. Through its sovereign wealth fund, the state has embedded itself in the fabric of the global economy. From luxury and logistics to media, finance, and emerging technologies, it has invested in icons, infrastructure, and ideas. And yet, for many, the scope of Qatar's influence remains elusive. That is not by accident, it is by design. Unlike empires of the past built on flags, force, and colonial power, Qatar's presence is almost entirely non-territorial. It does not occupy, it owns. It does not announce, it accumulates. The Qatar Investment Authority is not the face of the nation. It is its fingerprint, left quietly on assets, partnerships, and decisions that shape the world's future. To describe this strategy simply as investment is to miss the point. What Qatar has built is something closer to a system, a distributed strategic structure of influence that spans continents and sectors, but remains largely invisible to the public eye. Its power is not expressed through commands or press conferences, but through presence. Consider the reach. In London, QIA owns parts of the city's most iconic buildings. In New York, it holds stakes in private equity firms and commercial hubs. In Paris, it controls cultural touchpoints and fashion platforms. In Frankfurt, it sits on the boards of automotive giants. In Africa, it funds ports, logistics corridors, and development banks. In Asia, it invests in chip manufacturing, smart cities, and digital health. At each point, Qatar is not a dominant force, but a necessary one. Its capital is welcome, its posture is calm, and its track record is consistent. Over time, this combination of trust and liquidity creates something more durable than attention. It creates dependence. Even more remarkable is how seamlessly this empire blends into its surroundings. Most people shopping in Harrods, driving a Volkswagen, or watching a Champions League match have no idea that Qatar is behind the scenes. There are no Qatari flags, no loud branding. The country does not seek to be seen. It seeks to be unavoidable. It is a different kind of empire, one that thrives not on territory, but on networks, not on visibility, but on access. It builds silently, like infrastructure beneath a city, critical but unnoticed. And in that silence, it gains something empires rarely enjoy: longevity. But why does it work? Part of the answer lies in scale and discipline. Qatar is small enough to move quickly, but wealthy enough to move meaningfully. It does not need to please voters. It does not depend on quarterly returns. And unlike corporations, it can think across decades. Another reason is focus. Qatar does not chase everything. It specializes in key nodes, strategic assets, legacy institutions, and future technologies. It seeks sectors that define how societies move, communicate, consume, and decide. In doing so, it builds influence not through volume, but through concentration. And then there is narrative control. Qatar understands that to shape perception, you do not need to dominate all media. You only need to have a seat in the room. Through Al Jazeera, BIN, and cultural sponsorships, Qatar has ensured that its voice, however nuanced or contested, is always included. Still, this model is not without fragility. Its success depends on remaining quietly valuable, not becoming politically toxic. As nationalism and protectionism rise, sovereign funds may find themselves under growing scrutiny. Laws could change, sentiments could shift, access could narrow. Moreover, the nature of power itself is changing. As influence moves into the digital realm, where value is shaped not by ownership but by data, Qatar's traditional strengths, liquidity, land, and legacy assets may need new interpretations. Yet even here, Qatar seems prepared. Through its AI initiatives, digital infrastructure projects, and future-focused funds, it is already pivoting toward the next chapter. One where power is ambient, embedded in platforms, not palaces. It's worth pausing to reflect on what this means, not just for Qatar, but for the idea of power in the 21st century. We are used to thinking of influence in terms of visibility, who speaks, who leads, who commands. But Qatar shows that influence can also be quiet. That power can live in contracts, in minority stakes, in quiet boardroom presence. That ownership, distributed, discreet, and patient, may be the new diplomacy. And perhaps most intriguingly, it suggests that a country need not be large, loud, or dominant to shape the world. It can be trusted, embedded, and necessary. In the next and final chapter, we will close this journey by stepping back fully. What can we learn from Qatar's rise? And how does a calm empire sustain itself, not just through cycles of growth, but through the quiet passage of time? From the glittering towers of Doha to the historic streets of London, from boardrooms in Frankfurt to media studios in Paris, Qatar's quiet journey has traced an arc few could have predicted. It began not with a revolution or a resource war, but with something far less dramatic: the patient accumulation of trust, capital, and time. And now, as we reach the edge of this story, one question remains. What have we really witnessed? This was not just a story about a sovereign wealth fund or a small nation with big investments. It was about a new form of power, one that does not announce itself with military drills or sweeping declarations, but with partnerships, portfolios, and persistent presence. Qatar's empire is not built of colonies or currencies. It is made of connections. At every stage of this story, Qatar avoided the trappings of traditional hegemony. It did not impose, it invited. It did not conquer, it integrated. It chose symbols over slogans and structure over spectacle. Where others built brands, Qatar built balance sheets. Where others declared purpose, Qatar acted with quiet precision. This calm, almost meditative approach to influence raises a deeper reflection. In a world increasingly shaped by speed, visibility, and noise, what can we learn from a strategy that values time, discretion, and depth? Perhaps the most important lesson is this: influence is not only about scale, it is about consistency. Across 2 decades, Qatar has followed a single compass: diversify, embed, and endure. It has placed bets not just on markets, but on ideas, on green energy, digital infrastructure, art, education, and the future of intelligence itself. Of course, no path is without uncertainty. The world is shifting again. Climate change, AI disruption, political realignment, these will test the assumptions behind sovereign strategies. And Qatar, like any actor, must adapt. But it has given itself a unique advantage. Unlike states that rely on policy cycles or quarterly earnings, Qatar's investment system is guided by a long horizon. It does not need to impress today's headlines. It only needs to be relevant tomorrow. And perhaps this is what makes the story so quietly powerful. Because in a global system built on volatility, the calmest actor often holds the strongest position, not by force, but by patience, not through dominance, but through design. So as we close this journey, one image remains. A lone figure in the desert, watching as cities rise in the distance, not hurried, not uncertain, but entirely at peace with the long game. If you enjoyed this quiet exploration, Sleeponomics offers many more stories to accompany your rest. Feel free to subscribe, and until next time, sleep well.